Good night, everyone. Welcome to this Market Thursday. We are April the 15th. It's 7 p.m. here in London. And as usual, we're going to do those Market Thursday every 2 weeks. Today, I'm going to be starting with a quick disclaimer, which is, those webinars are not investment advice. So this is purely for information. So please do your own research before doing anything, putting any position. I might have some position in the different topics and ideas that I'm going to be discussing today, and might not have, and might have in the future. So please do your homework. So quickly for the newcomers here tonight and for the people on YouTube, I've started my career in 2000 as a cash equity trader, working for Pierre Charon Gestion, then as a fund manager for a company called DTAM. From 2004 to 2008, I worked as a European long only and as well on the long short for a hedge fund called Griffin Capital Management, where we had on the western part between 150 and 650 million euros. The company overall had between 2 to 3 billion. It's not here on my CV, but between this experience and Infinity Capital Market, where I worked from 2009 to 2018, I worked for Bernard Madoff. Bernard Madoff passed away yesterday, so rest in peace, Bernie. But I worked there for 6 months as a prop trader. In 2014, I worked for another company as a senior mentor. And since then, I've been mentoring tens of mentees around the world. And in 2018, I left. In 2017, I left that company. I restarted my own mentoring program in 2018. And in October of 2019, I launched the 4x4 video series. So what are we going to be covering today? We're going to be doing, as usual, the situation across asset classes, looking at the 4 asset classes and how those 4 asset classes have been behaving, looking at inflation, because that has been the theme for the first quarter for Q1. Really, the market was scared about inflation coming. And we see how the market has been behaving over the last 2 weeks. We're going to be discussing a bit about Archegos. So that's the family office that completely blew up. And there is the aftermath of Archegos and see what has been going. And plus, I want at the end be doing a bit of implied move and trying to explain how and how we should be looking at the earnings season and what is the market pricing in terms of move on the day through the option chain. So that's going to be a bit of teaching, but as always, I'm going to be taking an example. So I hope that's going to be helping you guys. In terms of market, quickly, the earnings season really started as of yesterday with JP Morgan and Goldman Sachs. Today we had Bank of America, Coca-Cola, and some other names. So that means in terms of stocks, equities, we have a lot of catalysts coming in the next 6 weeks, but more importantly, in the next 2 to 3 weeks. At the end, between the 23rd and the end of this month, there's going to be a lot of the FANG names, so a lot of tech names. So if you look at the option chain, there is a lot of positioning around the calls, obviously, because the market is very bull, but very bullish, and there is a lot of calls that are paid in the market. So in terms of the structure of the market, the outlier on the right-hand side of the market, which are the calls, the implied volatility is much more expensive than on the left-hand side, which is the put, because people are really retail traders based, not only retail traders, hedge funds, positioning is very much so bull, and meaning a lot of this bullish positioning is done with calls. Tomorrow as well, in terms of catalyst, we do have another catalyst, which is the expiry. So we get the OPEX, the monthly expiry. If you look at some websites, so there are some good websites which gives you the gamma exposure of the market and the delta exposure and so forth. So there is a huge gamma exposure in the market. So the market is really, really long, both in terms of gamma and delta. That might be, let's say, it's going to be reduced by definition from tomorrow, because some of those gamma and delta exposure, let's say between 30 and 50% of those positions of the market, will be closed as of tomorrow. So there might be a bit of reset, but market really has been on the one-way traffic, as we're going to see and as we discussed actually in the past. So again, tomorrow expiry on the S&P, and next Wednesday we get the expiry for the VIX futures. In terms of other catalysts, looking at the big picture, on the 28th, meaning very much so when the big tech companies will be releasing their earnings, we get the Fed meeting. So the Fed meeting, we had the CPI that we're going to discuss today, how the Fed is going to be behaving. As always, the Fed has been saying that they are keen on having more inflation coming, and it's all about wait and see. So let's start with the situation across asset classes. As always, here we have the year-to-date asset performance, and in the blue color, we have the indexes, the stocks indexes. Interestingly, most US, so that is as of yesterday, most US indexes are up 10% roughly, and a bit more for the Russell 2000. So that is as of yesterday. So if you add another percent from today, literally you are at 11% roughly, almost 8.5 to 9% for the Nasdaq. So if you think about the performance already, at mid-April, we are up 10%, which is roughly the average return that you have for stocks since forever. So over a quarter, we have been doing the 7-10%. Market has been really strong. So if you remember or not, maybe you can watch the previous webinars. We discussed the seasonality of the equity market in these months of April. And very often the market is strong, pretty strong during these months. Then there is a bit of cooling down in May and June, which has been confirmed. Again, now the market is up 5% on the month, seems a bit extended. We're going to be looking at the technical analysis, but it feels to me like the 41, between 41.60 and 41.80, 41.90, that is really important level. And I will say that either reducing your long exposure or starting a bit of a short, it's not necessarily a bad idea. But, you know, as always, as I said before, the disclaimer, you do whatever you want to do. In terms of indexes, we can see as well, again, the confirmation that emerging markets have been struggling. Okay, so emerging markets have been struggling since the start of the year. When we started the year in January, even better, market was really bull emerging market. If we look at EEM, which is 50-60% China, it has been not performing that well. We know that the Chinese market, the economy is not as bullish as it was versus the end of last year, both in terms of absolute term and relative terms. And as well, the Chinese Politburo is slowing a bit the amount of loans and credit giving into the market. So there is less liquidity or less financing, which as well explain a bit the slowing of emerging market. Emerging market as well, by definition, and unfortunately, are suffering more now of coronavirus because they have less access to the vaccines, meaning that in terms of relative trade, developed markets are doing better than emerging market. That is true for India, which is now showing really bad numbers. Brazil is the same as well. In terms of currency, I mean, there's a lot of noise. So currency that's going to be here. Now the dollar is trading 2 to 4% up or down. But if you look versus the euro dollar, if you look at the DXY, which is very much euro dollar, against many currencies. The dollar has been weakening, but to be honest, it's not. It has been coming back a bit, at least over the last couple of weeks. So we're going to see it again when we're going to be doing the technical analysis. Bitcoin, again, it should be right above here. The Bitcoin is up 100%. Gold is down on the year. And WTI is up 30%. Quickly for the week to date, again, recently, for the last couple of weeks, since the start of the month, we have seen a risk on in the market. Risk on that is due to very good economic numbers in the US. The economy is really, really strong. That is something that we have been discussing for the last 4 to 6 weeks. We know that the economy now is really running on steroids, both with the fiscal stimulus and the monetary stimulus. And really the trend that we saw at 38.50, at 39.50, even when we had the sell-off, I think it was a month ago, as I told you, the fundamentals, the drivers are pretty strong. It feels to me like now, again, there is a bit of you should put a bit of caution here, especially as the VIX or the implied volatility for buying the downside is, I'm not going to say it's cheap, but it's much cheaper than it was. And obviously at 16-17% for the VIX, actually there are some good trades to structure for some downside. But running against this massive bullish trend is always hard. So I'm advocating to put like a small starter position. But again, this is for you to take the final decision. In terms of sectors, for the newcomers here tonight and for the people who are watching on YouTube, what we do with the S&P is we look at the 11 sectors of the S&P 500, which are here, as we can see, are going from the energy to the technology sector. As WTI has been really strong, energy obviously has been strong as well. Financials have been benefiting of two things: the better economy and as well yields going up and the steepening of the yield curve. Some other sectors have been struggling a bit more, like consumer staples, utilities. So the defensive ones have not been doing that well. But overall, most sectors have been doing okay. If we look at the week-to-date sector performances, it's very much like the market. So the beta is playing perfectly its role. There is a bit less alpha generation here. If we look at the right-hand side of the year-to-date, we can see as well that IT or technology, which used to be really outperforming the market, is telling us exactly the same as the Nasdaq composite before. It has been a bit underperforming the market year-to-date. But we need to put everything into perspective. Technology has been outperforming the market massively since 2016. And it's mainly in March where we had a strong rotation. So the rotation started in September last year. That was confirmed as well in October, November with the election in the vaccine. And there is some rotation. So the S&P is making new highs, but technology is not. So that tells you another thing, that tells you that the market is still looking for new leaders. As well, if you do some screening on breakout, so that is something that I always advocate people to do, and I try to teach it during the 4x4 and a bit as well during the mentoring. If we do breakout, meaning the leaders of the markets, you get less stocks that are performing or breaking out. And finally, if you look at what is making the market going up, so that will be the market breadth. The market breadth of this market is less and less strong. So again, when we come into the earnings season, there is a lot of unknown. the trend is always could be, let's say, we are waiting for new leaders, but really the market, despite going higher, or it's not despite, should I say, is really everything is going higher without any leader. Next one is the one that I like as well, looking at the other asset class, which are the bonds. So we know that the bonds, based on inflation expectations going higher, so the reflation trade and the economy doing much better in the US, bonds have been selling off, and sorry, the yields have been going up. Today, there is a big move for bonds going up, so there is the reversion of the trade that has been working since the start of the year. So we're going to see later that the US 10 years is trading at 155 after trading 175, 180% recently. Same thing with the VIX. So the VIX is not a perfect metric of where is the volatility, but that tells us still a lot about implied volatility. The VIX is now below 18%. It was at 16.5% before today. So clearly this is a low level for the 4x4 subscribers. I strongly advise you to look at the rule of 16 on the VIX and how we calculate the VIX and how we look at, based on the normal distribution, the potential move on the S&P on each and single day. In terms of top winners and top losers, you have some, as always, some funny names, but I think one of the names that is coming out, which is GSX. So GSX is one of the positions that was held by Archegos. So the stock was on fire last year. I tried at one stage to go short with options, and it didn't work that much, that well. But the bottom line here is GSX was pushed as a short by many short sellers. I think what is interesting, if you have a book, if you're running a portfolio, always listen to these short sellers, because their expertise and their knowledge is to be finding those dodgy names. We are talking Muddy Waters and some others, and they really have some expertise. So the only problem that you have, so you are facing two issues here, is the market structure, which is, market squeezing, and here we get a special situation, which is this cornering of the market by Archegos. And the second idea as well, when you look at what is our short sellers doing, always be careful, because their time frame might be very different than yours, and actually they reckon that sometimes they are struggling with their timing. So if you look at stories like Wirecard, GSX, many names, before it's going out there, it could be taking a lot of time. So, and as well, you can have issues with the board. You're gonna have issues with the cost of the implied volatility, meaning doing with options is going to cost you a lot. So my philosophy is, especially for retail traders, you don't need necessarily to go with them, but at least don't go against them, because in the long run, 99% of the time, the good short sellers are going to be right. And trust me, if you look at GSX that is trading at 25, that is a confirmation that those guys are good. So next one, central banks, and I'm looking at the euro-dollar future. So that's something that I've been doing over and over. So I strongly advise for the people on YouTube that are new to that, to be looking at what is euro-dollar and explain it a bit, but as well what has been the change from one, let's say every 2 weeks, from one webinar to another. And the idea is, with the euro-dollar futures, to understand what are the market expectations towards the Fed moves in the future. As we can see here, from September 2022, roughly to December June 2023, here the market is more or less expecting 25 bips hike from the Fed, and that was at the end of March. If you look at those same data, that was a couple of days ago, and I think it's even worse today. there has been some slowing of the Fed expectations to rate hike in the near future. So as we can see here, the 99.5 here goes to 99.56, and the 99.22 from June goes 99.32. So the odds of the Fed doing hiking rates from December 2022 onwards have been lowered a bit. So it feels like since the end of the quarter, which was more or less the top of the yields, 10 years, and the expectation from the Fed, we had a reversion to the, is it a reversion to the mean? Is it more than that? Are we going to have a follow-up pretty soon? But overall, the whole yield curve has been moving pretty much the same. And that is as well due to, as we're going to see, the inflation expectations not worsening since March. Next one is, yes, so that's the inflation expectation, sorry. So that's the one that we discussed before, that was a couple of weeks ago, which are the US break-even 10 years. So that's more or less where we see the inflation coming in the future, and we should be taking 2% as the threshold by the Fed, which is based on their mandate. You can be looking at CPI, more importantly core CPI, but PCE. And as well, you can see that the trend has been, so there is consolidation. As always, consolidation is, you don't know for how long it's going to be, or if it's going to be a reversion to the mean, but that goes hand in hand with the bond market and the Fed expectation. What about now? We go into some technical analysis. So here, we're going to be starting with the S&P 500 futures. Over the last 3 months, I've been telling you that the trend is your friend, and as always, be careful with the trend, because it's your friend until it's not. But clearly, this is the levels that I'll be looking, and as you can see, we are getting closer to the top of this trend. Again, look at the calendar, look at what is happening. We get a lot of very long gamma exposure. We have expiry tomorrow, so that means in terms of odds, you are closer to the resistance than to the support. On the contrary, I mean, not on the contrary, but if you look at the Nasdaq Composite has not been making new highs yet. If you think about, cup and handle, or if you think about, making new all-time high, we are not that far, but we have not reached that level, which tells you again what I was saying before. The market is not driven by the usual leaders that we had since September 2016. If we look at the SOX index, which is the Philadelphia Semiconductor, it has been making new high, consolidating. There has been some dispersion in the market and in the sector and the industry, with NVIDIA, for instance, doing very well, and Intel kind of digesting the information based on the new competition from NVIDIA. The Russell 2000, so we have been discussing the Russell 2000 since the election. So we had a massive move since the election. So the breakout really happened right after the election. And the Russell was up almost 20% at one stage in Q1. And again, since then, market is consolidating. So the rotation, value versus growth, small, mid versus big caps, there is both reversion to the mean and digesting from the market. That is, the digestion has been ongoing for the last 2 to 4 weeks after a very strong move. If we look at IWO divided by IWN, so for people that are watching, TradingView is a good instrument. Everything is for free. And the way to look at the ratio, you do one divided by another. So IWO will be for the Russell growth versus the Russell value. So that was for last year, the big move, which was based on the world closing and people going massively for growth stocks. And since then, we have been, since the election, we have been reverting half of it. So more importantly, there has been a big reversion in February. So if you've been in the market in Feb and March of this year, there was quite astonishing dispersion in the market. So literally you get sectors like XLE, XME, very, very strong, and actually some other stocks like IT that were struggling. So for many hedge funds, for many long short, I can tell you that in Europe, I have a lot of friends and ex-colleagues who are still running some books that have been, not in prop trading, but for hedge fund, many hedge funds have been struggling because the dispersion has been massive. So when you have a lot of exposure, and you have dispersion like this one, it can be extremely painful. So clearly, if you look at the performances, at least in Europe, for Q1 has been pretty bad, despite the market up 10%. So that's for IWO versus IWN. I think one chart that is interesting. I'm not going to be doing as much chart as I did last week, a couple of weeks ago, but XLV has been performing pretty well recently. It's making new highs. Today is a very strong day. It feels a bit like topish here. Again, this is not a call. I might or might not have a position, but I advise you and strongly encourage you to be looking at the different sectors. I got a question from Tony. Can we see your charts in TradeView, or are they private? No, I think they are private. It's not that I don't want to share. I'm happy to share. I'm not sure how to do it. I think everything is private here, but maybe that's something that could do in the future, sharing my chart. I don't consider myself as a very good technical analyst. So I do basic stuff. I do support. I do resistance. I do a lot of volume. I don't want to do too funny things. I don't want to go into pretending like most trading educators that you're going to have a magic formula doing technical analysis. Just a confirmation at the end of the process. So looking at the price action is telling you, the market is telling you, so it's like listening to music and dancing in rhythm, and that's the same with technical analysis. Let's look as well now, moving from this to bonds. So the 10 years that I mentioned before up, so sorry for the chart. So as we can see today, we have a big move. We are at 153%. So bonds are up massively. I don't, it's not necessarily inflation expectations that are turning. You can argue that the move was very, very strong year to date, and it was calling for reversion. I didn't call it at all, but 1.5% on the US 10 years. So we're coming back. If you think about the implication, that means as well that some sectors that have been benefiting massively, like financials, for instance, might not be as strong as they were before. So that's for the 10 years. That is for the yields that are coming. The US 30 years as well was moving big time today. So there is a move in the market. So there is asset rotation here. But when I say that, actually, it's not completely true, because it feels like everything is on the bid. So we are talking bonds, we are talking stocks, we are talking commodities, we are talking gold. Everything is bid. So a lot of liquidity, a lot of risk taking. There have been many aggressive and bullish comments posted by Bob Diamond from JP Morgan and the BlackRock CEO, but we are at the start of the cycle, that they are really bull. We need as well to take a pinch of salt here. By definition, either Bob Diamond and BlackRock are long-only people. So that means that they're going to be making more money when the economy is doing better. But, there is no arguing here the economy, the US economy at least, is doing much better, and it is pretty aggressive based on the steroids that we are giving to this economy. There is one quick question from Rika. Let's try to, Gregoire, can we assume that we are shifting into a more defensive portfolio due to the current trends then? I mean, that's this question is a tough one, because if you look at the macro numbers that we had today, so the retail sales were really good. Obviously, you have a calendar effect, but still, they were much better than what was expected. Confidence is really high. What is hard is to think: is it just a recovery based on what happened before, which is the end of the world? Or is it a new cycle? So if you look at Bob Diamond, if you look at some other people, they are telling us that we are start of a new economic cycle. It is true that the Biden administration, by putting a lot of money into the system, will help the economy for the next at least 12 to 18 months. The question is how sustainable it's going to be in the future. You still get COVID that is around. There is a good FT article today about the variant that is getting worse and worse actually in London. So despite the London numbers coming down, there are some scare that the variant could be stronger than expected. I think, to come back to your question, Rika, sorry to be a bit long on this, the earnings season is going to tell us a lot. So far, the numbers, I mean, we are only talking 2 to 3 days, but it feels a bit like it is a bit like traveling and arrived, meaning that stocks were doing very well. And if you look at JP Morgan and some other names, for instance, JP Morgan was doing very well, and then on the earnings did a bit not so well. In Europe, you have the same as well, with some good news, and the stock, kind of, as if a lot was priced in. So we're going to see, you can argue that the good thing is like the 30-40% of the market, which are the tech, have not been behaving so well versus the market. So maybe that's going to be the other leg up. Okay, let's. So we've done US 30 years. Let's go quickly through my note. Yes. Quickly, let's look at crude oil. So we're going to do this contract. So crude oil, same, very strong on the year, has been coming down from the high recently. Interestingly, I think because the Saudis, because OPEC have been really cutting the supply, they are part of the world which needs more oil. So demand is roughly down 5% versus pre-crisis. But I read, I think it was yesterday on Bloomberg, that some reserves in the US are 30 years low. So that means we need to be, and the OPEC need to be careful not to be cutting too much of a supply, because that could put in danger as well the restart of the economy. I think the other one that I'm interested in, and probably most of you as well, is the copper. So copper has been trading nicely on the support. It has been quite strong today and yesterday. So that is, as we know, Dr. Copper is normally telling us a lot about how the world economy is doing and how normally China will be doing. So last couple of days, price action is strong. Again, across asset classes this week, a lot of risk is on. A lot of liquidity, a lot of names, a lot of assets are going up. Finally, for the gold, because I had some questions and some people on Twitter asking me. I think the 1760, 70 is really the resistance that we broke recently. I don't have much of a view on gold. I'm afraid each time someone is asking me about the gold, I'm again, the only thing that I can say, I'm not a big fan of gold. This is just something that I'm always struggling to have. So I'm just doing trades, literally once every 12, 18 months, where I think it's the risk reward for a big move is interesting. Otherwise, to trade the gold or to make 5, 10, 15%, I'm pretty bad at it. So if you're looking for some gold expert, I think you're going to have many with the retail world, especially retail education, where many people are just pretending that they are good at it. Quickly, last one with the currencies, euro dollar. So euro dollar, as I've been saying, so I'm going to be putting this weekly chart, and I keep on saying the same. So that is the big trend. We have been bouncing around this. I was saying, 116, we didn't go, we went into the 117 and below. So we are kind of bouncing into this level. A lot will be around COVID, obviously, how the Europe is going to do versus the US, and as well, US 10 years versus the bond and the carry trade. As well, in terms of other currencies, which one I wanted to, the one that I flagged a couple of weeks ago, I think this one is really one to follow, which is the Brazilian real, and how I think if it goes, there is a lot of emerging markets that will go with it. So if you, this is really one to monitor. Let's go back to the presentation where we were at inflation expectation. So quickly, earnings season. So we are in the middle of so we just started the earnings season. So what I strongly advise you to do is to be checking which company is coming every single day. So if you are on Saturday, if you are watching this video this Saturday or this Sunday, what you will be, or what I would be usually do is on the Sunday, I will be putting into my calendar what are the companies that will be coming for the week. So here, this is the example for Friday the 16th, where we're going to have Morgan Stanley. So we had a lot of banks, so it's not as important as before. Literally, JP Morgan is really the driver. We know that JP Morgan, Goldman Sachs, Bank of America, all said the same, that their investment bank and their trading was really, really strong. So they were very active in Q1, but the loan business was not as good as they wanted to be. Especially Bob Diamond was saying that because of the new Fed regulation, they might be struggling to give as many loans as they would like. But that's what is important. If you look at the sectors that we have before, if you look at the industries, you try to identify what are the drivers, what are the big companies that are coming with the data. So if you are looking at banks, you're looking at really the leader, which is JP Morgan. If you are looking at some software company, obviously you'll be looking at Microsoft, you'll be looking at Adobe. And as always, you want to know what are the leaders doing, and as well, you want to know, if you have a position, what are the companies that are either the leaders or who are the competitors when they are coming in the market, and when that might affect your position. So tomorrow you have this. There are 3 websites and many more websites that you can be using. Here are listed: investing.com, earningwhisper.com, or Benziger. Really try to put and follow up, which companies are going to be coming. Here I take the example of the US. That's the same with Europe, and that's the same with any part of the world. Earnings season. So here I listed again. So from the 16th to the 19th, and some names that could be interesting. We are talking both Railing with Kansas City. We are taking again with Morgan Stanley. We are talking with steel, which has been very strong based on the infrastructure trade. We know that's something we covered, that since the announcement of the Biden plan, or the Biden infrastructure plan a couple of weeks ago, a lot of steel names have been coming down a bit, between actually down 10 to 20%, and some of the names like the miners have been doing very well, like Freeport. And again, knowing when those companies are going to come to the market, when is the earnings call, it's important, because if you have a position, that might impact your positioning. So look at sectors, look at sector and industry leaders. if they beat or not, and what are the comments. And again, if you have a position, look at the competitors and when they could be releasing and on which date. Inflation. So inflation, we had the CPI that was a couple of days ago. So looking at the CPI, you have different level of CPIs. You got the headlines and you get the core CPI. The Fed is interested in that one, which is the core CPI. They are more interested in the core PC. But let's start with the core CPI. So the core CPI is at 165% year on year. And obviously, after what happened last year, the next couple of months, this core CPI is going to be above 2%. So that means the headline number is going to be looking bad, in a sense that if we think that the Fed expectation here in gray, this is the 2%, we get clearly it's going to be there. So the Fed said, you know, we wait and see when the inflation is going to be above 2%, we're going to do something. And maybe it's not going to be on the 28th of April meeting, but pretty soon they will have at least to change the wording. So here, this is for the 4x4 subscribers. This is the one of the spreadsheets that we have. As you can see here, April numbers were pretty, so we had a dip, so meaning year on year. In the next 2 months, it's going to be looking way above 2% normally for the core CPI. Now, if you, again, this is something that we explain in the 4x4, and this is the correlation between the core CPI and the Fed fund target, or maybe not the correlation, the causation, which is when you have low inflation, the Fed fund target or the Fed policy is pretty accommodative. We have been in a world since the start of the 80s with inflation coming down and down and down. So if you have been running a bond portfolio since the 80s, you have been making a fortune because there has been low inflation and yields have been coming down and down. So if you think that inflation, there's going to be a confirmation that inflation will start to pick up because of the monetary stimulus, but more importantly, because of the fiscal stimulus, we should expect Fed expectations and the Fed fund target to go higher. Quickly, I would like to discuss about Archegos, because Archegos, we discussed that a couple of weeks ago. So that's the family office run by this Tiger Cub, in Asia, run by Bill Hong. And I think what is interesting is a couple of weeks ago when we discussed this, we were, and the expectations and the feel was all the positions were not closed. And even a couple of days ago, or I think it was, yes, that was a couple of days ago, Credit Suisse was still selling position and doing some blocks in the market. So 19 million Discovery class A, 22 million class C, and 35 million EQE, meaning that we still don't know what has been the size of the pain. We know that Credit Suisse said that the pain for Q1 was, I can't remember the number, was it 6 billion? But actually that was the pain for Q1, but they haven't finished closing their position. But that tells you a lot about regulation, about family offices. So people are being moved due to regulation in Europe and in the US and in Asia, and the cost of regulation. Many wealthy people and many fund managers have been moving from hedge fund structure to family offices. The problem with family offices is, as it is less regulated than hedge funds, there is a lot of opacity. There is a lot of leverage. There might be a lot of leverage. By definition, you know, the prime brokers want to make business and they want to get commission. So if someone like Bill Hong and the Archegos is putting a lot of commissions, it's easier for people to close their eyes and to change the metrics of their risk management. But that tells you a lot about prime broker, excessive leverage. And going into the next slide, so that was the chart are 5 of the stocks that were in the Archegos book. As you can see, they try to corner some of those names, or most of those names. Here, GSX is not on that one, so actually I should have added this one. So they try to corner the market, literally squeezing the market with insane exposure. But as well, one of the things that I experienced over the years is when you have a big move like this, and the headlines are, Credit Suisse is down or Morgan Stanley is down, blah, blah, blah. Be careful, because you should always assume that there is more to come, okay? Because when people are announcing that everything is done, that it's just not true. And actually, if you look at the next slide, you can see that those stocks carried on selling off. So be careful on trying to find the bottom on those extremely pushy and aggressive cornered stocks, because again, go back to the fundamentals, go back to where the stock should be if you didn't have these external moves. Finally, I would like to share the chart of Credit Suisse. So Credit Suisse. So here, this is the price in Swiss franc. So similar here. Be careful on entering early, and I'm talking the long. If you're short, all good so far. As we discussed before, GSX, which is this Chinese education story, was really a rubbish story. But if you went short last year at 50 and it went almost to 150, I think it was at the start in January, but I remember last summer as well. Some put, I think I had some put 60, 40 or 40, whatever. I never really made money out of it, but I didn't want to go short those names with stocks, because when it goes from 60 to 150, if you get a portfolio, you don't have any portfolio, and if you get a job, your job is just firing, your boss is just firing you. But the bottom line of all of this is be careful when you play those names where you think it's overextended, because there might be more to come. Now I'm going to be doing a bit of maybe teaching, call it teaching. Maybe it's going to be boring for some of you, but I think this is interesting. So this is something that I discussed as well in the 4x4. So I take here the example of UPS, which is same as FedEx, as you know, so delivery. And pretty soon, in the next 15 days, UPS is going to come with its earnings. And I think when we have a position or when we don't have a position, we're always interested to know and to try to guess by how much the stock is going to be moving on the day. Okay, so that's the implied volatility. So if we look at UPS, this is a United Parcel Service, which has roughly, that was a couple of days ago, 156 billion market cap, and the earnings are on the 27th of April of this year. So I took the last at which was on the 30th of April of 178.75, and I tried to identify the implied move that was expected around the earnings. So to do so, I look at the implied volatility for the at the money, meaning close to the last of the put and the call, which are expiring at the end of this month on the 30th of April 2021. So if we look at the at the money put and call at 177.5, so you have a 33% implied volatility. So here, if we look at 177.5 strike, and if you look at the call, which is here, and if you look at the implied volatility on the call and the put, you get 33%. So based on that, now we're going to try to identify by how much the stock could be moving on the day. So what we will be using is we're going to be using the bid-ask of both the call and the put. So let's go into the next slide. To do so, we're going to be looking at the weekly straddle. So what is a straddle? A long straddle is a neutral strategy when we buy a put option and a call option with the same maturity and the same strike price. So what we would like to have is the stock moving big. Most of the time for retail traders, and that's explained in the 4x4, doing some straddle or strangle, the risk reward is pretty bad, because you need a huge move to be making money. So that's one of the strategies that is not really interesting most of the time. As always, is most of the time. But I think at least what we can have from it is understanding by how much the stock is going to be moving, could be moving on the day. So if we take the example above, to cover the earnings, which are coming on the 27th of April, we're going to be taking the next maturity, the closest, which is on the 30th of April. And if we look at the 177.5 call, it was trading between, the bid was at 565, offer at 5.9. So if you take the mid, that gives you $578. For the put, you have $453. So if you aggregate 578 the call plus 453 for the put, and you divide by the last, that's going to give you a 5.8%. So based on the earnings, based on the option chain, UPS is roughly expected to move by 5.8% on its earnings. So I think what is interesting here and what is important is if I tell you UPS is moving by 5.8%, the first thing that you're going to say, or you could say, is it big or is it small? Okay, so you're going to start to be making a decision. What always helps when we look at implied volatility is to compare implied volatility with realized volatility. And what is realized volatility is most of the time what happened in the past. So what happened in the past, what I did for you, is I look at the earnings of UPS for the last 10 earnings and what was the move on the day based on that day. So as we can see, move on the day, 4.5% on this during the, so here this is Q4 2020. We moved by 4.5%. Earnings before minus 4.5%. So what you're going to be taking is the absolute percentage move on the day, and you end up with an average 5.2. So here you can see that you have an outlier, but outliers for stocks always happens or might happen. So that means, you know, you need to take, when you do those average, you need to be taking enough data to mitigate those outliers. And if we take the high versus the lows, on the day, we had a 4.7%. So remember what we had before. Before we had a move of 5.8% implied move based on the value chain, the option chain, and versus 5.2. So as always, what is interesting is implied volatility 99% of the time is higher than realized volatility. Why? Because as market participants will be overpaying or paying more for the protection, but as well you can see that implied volatility is not very far off from realized volatility. That tells you as well that, you know, sometimes you come with an idea of a stock and you say, oh, this stock is going to be moving by 15%. And actually the market is going to be pricing 5% or 10%. So depending first where you think that by how much the stock is going to be moving, and you know, if the implied volatility is underpriced or overpriced. So that was the case previous quarter, I think was previous quarter, where Goose, so Canada Goose was expected to be moving 10% and the stock moved up 20-25%. And as well, for us, for the learning curve, it's pretty nice to understand, you know, roughly by how much a stock will be moving. So if you have position coming into the earning, and I hope, you know, some of those are well hedged or most of them are well hedged, but at least you can be already, you can already know by how much the stock is expected to move by the market. So quickly, education, presentation of what I do, what I can offer. So we launched when I say we, is I plus the users from the 4x4 and the mentoring students. We launched a community. It's taking shape. I think I need to adjust a bit and making it a bit more complete. But thank you for the people that are joining and putting some content. I think this is something that works well. It's nice to have educated people and have people that are joining. So let's carry on. Second part is the 4x4 video series. So this is a video series that I launched in October 2019. So that it's based on exactly what I do, and during those presentations, those webinars, that is based on my experience as a long only, as a long short, as a prop trader, as a portfolio manager, where ID generation is coming from 4 filtering processes: top down, bottom up, special situation, and active trading. You're going to have access to 40 video plus, more than 30 hours of footage, 50 Excel spreadsheet. I know that some educators are trying now to catch up because they know that the product is much better. So you can be buying the original now instead of buying a fake in the future. So it's that's what you can have. I think what is important is as well for you to have all those Excel spreadsheets. So I'm not asking people to pay extra money for data. You can have access to all of this with the Excel. If you want to have more in the second phase of your learning process, we can be discussing another API, Excel API. In terms of the next level, which is the mentoring program, so you can be doing the mentoring program, which is one-on-one session on Skype or Zoom. I'm pretty flexible. It's 12 weekly sessions. When I say weekly, it's over 3 to 5 months. It is similar to the 4x4. It's about building your infrastructure and really, more importantly, learning how to trade your money in real time. So if you think about the 4x4, it's about putting and learning the process. And we know as well that putting money at work is very different from paper money. So I help you doing the quantitative analysis, the qualitative analysis, the infrastructure. So it requires a lot of work from you. So I'm not pretending that we're going to be doing RSI and some support and resistance, and this is it, and we're all going to be rich after 2 hours. It's about 10, 20 hours at least between each session. I know that some of my mentees are watching today and are watching on YouTube. They could tell you that this is hard work, because I think the more you do, the better it is. And I always try to push you as much as possible. So it is about 2 things. Either you want to be managing your money for the future and in the next 50 years, and as well, if you want to have access to the industry. So recently, I placed someone in working for a hedge fund. So he was happy today because he's got his Bloomberg. So he just had today the access to his Bloomberg for at least 3 months. So he's very happy. So that is what I'm trying to do. I'm not bullshitting you as well. I'm not going to pretend that you're going to find and I'm going to give you a job somewhere. I try as much as possible to help people. This is the same with the community. And if you want to be building your track record that's something that is helpful with the mentoring. Should we jump into the questions very quickly? If you have questions, go on the website. You can send me emails. I think I would like, if you like the content, please, how do you say that on YouTube, make positive comments, because that gives traction. That is good to have positive feedback, because that brings new people, and that is important as well for the community. Any question from anyone? Or maybe this is it. For the YouTube watchers, if you have questions, send me emails. You can as well register to get emails for the next webinars. But other than that, I think this is it. If you don't have any question, Rika, you got a good question about, so clarification. How can everyone say the economy is good, however the jobs report are horrible? So The job report is a lagging indicator, Rika. So I hear you that the unemployment is like 6% plus, which is not as good as before, the 3% that we had pre-crisis. But the better the economy is going to be, the better the unemployment numbers are going to be. So again, leading indicators like, you know, ISM, like housing, like confidence are telling us that the economy is going to be doing better. So job, NFP are lagging indicator. We know that the US economy is doing much better, and it's doing pretty well. I hear you that it's not perfect, and this is why the Fed is pretty aggressive, and the Biden administration is still aggressive. But you know, if we carry on with that path, in 12 months to 18 months, we're going to go back to the 3% job unemployment. So it's not perfect, and by no means no one is saying it's perfect. But you know, the economy is doing better. Question from David: how come the energy sector has been staying flat these last couple of months? If you look at XLE, to name one, which even if it's not perfect, because XLE is 50 to 60% around two stocks. If you look at WTI, at the start of, let's say, November, XLE was trading at 27, 28. That was the end of the world. And since then, we went from $27, $28 to $50 and almost $54 roughly. So the sector has been extremely strong. We were up 40% at one stage on the XLE. So in terms of digestion from the market, and as well as I mentioned before, if you want the energy sector to carry on like this, you need a strong world demand coming. Okay, so if you look at the OPEC numbers, if you look at the oil numbers, which are roughly, before crisis, we were consuming 100 million barrels every day, whereas these days it's 95, 96 million barrels. So that means based on the world consumption, we are down 4 to 5%. So the only reason why, the only reason why oil is at 60 and above is because the Saudis, OPEC, reduced production massively, and as well, a lot of US production has been coming down. But structurally, the sector is not as strong as before, because again, the world is not as strong as it was before. Okay. I think this is it for today. Again, if you like these videos, plus please make some comments, do some like. I know it's a bit boring when we say that, but that helps. Thank you for joining, and talk to you in a couple of weeks normally. Have a good one. Bye-bye.